Hey everybody, Marty Missouri here. It's after hours on Thursday, the 22nd, 2023, 22nd of June. This will be the end of week stock market update, which I will send to clients for tomorrow, Friday morning message, and then get right to work on our weekly economic update. And keep this one pretty short. There are a few things I do want to spend a little time with you on. We can just roll through the charts because nothing has really changed. Certainly on the daily, we'll take a peek at the hourly charts for both the S&P and the QQQ ETF because they do look a little more constructive on the very short term. I'm going to touch on market breadth once again through a few metrics and then two or three charts that I've copied and pasted that I want to share with you. So in front of you is the S&P 500 daily chart, and as the pattern would suggest it should, we have broken down below the bearish rising wedge pattern, and that would be your sell signal, particularly if you could get one to materialize right here, and that would be the white line dropping below the red line. But just the breakout of the wedge, you could argue, particularly if you have a bearish divergence, which technically we do right here, and coming off of the most overbought spot we've been during this entire bear market here on the RSI. But when I look at the hourly chart, the S&P did come back, particularly late in the session today, and closed higher. We'll put that in perspective here in a second when I talk about breadth. So on the 60-day, 60-minute chart, yes, we had real bearish divergences. Sell signal came down, but not by a whole lot, right? And remember I said we had this bear flag right here, and that did not play out. Almost, I guess, but not quite. And now what we have is an area there of support from back here a few days ago. And you can see the MACD is about to roll into a buy signal, and I would call this a bullish divergence on the RSI. So very short-term stuff, signaling that momentum could follow through to tomorrow. On the Qs, the NASDAQ 100 ETF, same thing, broke solidly out of the rising wedge. Do have the sell signal, I'll call it, on the daily, coming off of massively overbought territory, but a big, strong, actually technically engulfing candle because it captures high to low. It captures the day before. That's actually a bullish candle, and that portends something special tomorrow, perhaps, at least technically speaking. Same thing when I drill down on the hourly chart. We had just your perfect rising wedge, perfectly bearish. Broke out right where you tend to, had negative divergences. Short-term traders can do really well trading these technicals, but those would be short-term day traders who just do it all day very nimbly and understand the technicals. Do have a little buy signal right here on the hourly. You can see we're kind of fighting our way back. So would not at all surprise me to see even tomorrow come back and at a minimum test this uptrend line. Not going to burn through these divergences, so that would be another objective shorting opportunity for those short-term traders. But right now, I'd be cautious being short. The S&P closed up 37 basis points, a little better than 1/3%. The NASDAQ 100 closed up over 1%, so a big day for the NASDAQ, big down day for it yesterday. Of the 500 plus companies in the S&P 500, 322, so call it more than 60%, were actually down on the day when the S&P was up. The NASDAQ, which was up big on the day, you're looking at 60+% of those down on the day. You can see you had 7 stocks making a 1-month low versus 6 making a high, and so on. In terms of breadth relative to moving averages, again, you have the S&P up above its 50-day moving average and up a bunch above its 200-day moving average, and barely half of the actual stocks in the index are actually above their respective moving averages. So not at all a healthy market still from a breadth standpoint. Now, the advanced decline line for the S&P actually was threatening to break out to the upside. It looks like a false breakout because it's rolling right back over. The S&P 500 versus the S&P 500 equal weight. This is the ETF that tracks at that yellow line. I do that because for some reason the equal weight index is always a day behind. Still a massive gap between the two. Some people have been talking about this move higher right here. So there has been a little bit of catch up, but it's still a big gap between the two, which speaks to the lack of health of the market. And absolutely, as the bulls portend, we could catch up from this. It could be that breadth widens out and it catches up here. You can see here just today, just more recently, looks like that negative breadth scenario is coming back to life here. So the bull bear spread for individual investors, the AAII, you can see we drew this big gap right in here, biggest since the bear market began. So bullishness came down a little bit and bearishness came up a little bit this week, or for last week's survey. And so we'll see how this plays out when it's peaked here during the bear market, particularly after it's crossed over, or if it's gotten close in here. It's been more than a little give back in just about every case. Not everyone, but just about. So we'll see. This is the widest divergence, meaning the most dangerous from a sentiment standpoint when we're talking individual investors, and here's where we are right here. And then that Investors Intelligence weekly survey, which gives us what newsletter writers, what advisors are thinking. The bulls, as you can see here this last week, edged higher to 54.3. The bears edged a bit lower to 20.0, and then we look at the bull bear spread, expanded to 34.3 from 32.8 a week ago. You can see that's up 13% from early May, and it's the largest positive divergence since November 2021, right before the all-time peak. When you get above 30%, that's a sign of elevated risk, and again, sentiment has been a really good tool for us in terms of gauging market direction. And right now, looks like the bulls are getting a little bit out over their skis, at least potentially. Interesting stuff. And folks, again, as I keep reiterating, I'm not doing this to tell you that we're bears and we're right. What I'm doing this is to tell you why we continue to hedge portfolios against something major to the downside. So in this case, what's being called the equity risk premium is the S&P 500 forward earnings yield less the 10-year treasury yield, and it is way down here in the gutter. And when was it down here in the gutter like this before? Right before the massive great financial crisis and 60% drop in stocks. And right here when we were kind of wrestling with a number of things, not the least of which being the European debt crisis when you get out in here as well. This was a real rough patch for stocks. In 2011, there was a 19.8% correction. So again, just something to think about, just a warning sign, if you will. This is that AAII bullish sentiment. That's what I just showed you, the spread. They're just pointing out here that it's really high. And it was really high before the bear market we think we're still in, right? And before the COVID mess as well. And lastly, equities, according to Goldman, their positioning indicator has moved into stretched territory. They measure stock positioning across retail, institutional, and foreign investors versus the past 12 months. Reading below 1 or above 1 indicate extreme positions that are significant in predicting future returns. They're suggesting that this is a harbinger of a move lower in stocks. So anyway, lots to parse here, folks. We'll continue to do it for you here on the blog, and I'll leave it there for now. Thank you, as always, for watching and listening. Be back probably by the end of the day tomorrow with our economic update. Take care. Bye-bye.